If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show. Good morning, everybody. Welcome back to another live trading stream. Hope you are all doing well. Just pulling up here. Sorry on my end. I'm just finishing something I was caught up in, and I totally missed my start time on the stream. I'm sorry about this, guys. I just have to finish an email. Okay. Good morning. Good afternoon. Hope everyone is doing well. And I hope you are staying safe in these crazy markets, man. Gold is erupting. I feel like I say this every single day, but it is true. We've got this massive, massive runaway move happening right now in precious metals. But specifically today, it's gold, right? Gold is actually taking the lead over silver, at least in the last like 2 or 3 days. Gold is up 2.11% today. Somebody had a good question inside of the group today. They asked me, Nick, if you think about it, with this position, because I haven't trailed my stop loss further, are you not floating this type of position, right? Because I'm still in a trade from when I initially went long gold right around the end of last year, the 31st, went long gold again, at another entry on the long side. And price has erupted higher, right? And I've only trailed my stop loss to just behind this prior all-time high. And so the question is, when we look at this circumstance, we say, okay, well, I've only trailed my stop loss up to this point. Technically, I could give back at any moment a huge amount of the profit. And this is one of the more difficult components of my style of trading, where I do the trailing stop approach, because what can happen to you is you can get a situation like this where you have a runaway trade. And you know what? It has happened to me in the past where this has occurred, and it is frustrating because you can give away a lot of gains. That being said, I also don't have a logical place right here to really put a stop loss that I feel really good about. Do I put my stop loss here? Maybe. But I like generally to get some sort of structure involved in my trailing stop. So for example, if we were to get this move, if we were to see this move, right, and then that move, then I have a pretty obvious thing to do with my stop loss. I just move it right there. But because I don't have any sort of structure to go off of, the most I could do would maybe be trail my stop just a little bit tighter behind this area. But I don't want to get too close because, again, you could have this happen and it still be a very normal component of an uptrend. How do you protect against a huge overnight drop that doesn't trigger your stop loss? That's a good question, especially since I trade ETFs where there is a market closed period. And the answer is I don't. Sometimes it gaps below my stop and I give back more than I wanted to. Sometimes, however, double-edged sword, sometimes this is a very extreme case, but let's say, I'm trading the GLD ETF, it's closed, right? Futures trading goes like this and futures trading does like this. In those circumstances, I won't be stopped out. I know it's kind of confusing for non-stock market or ETF traders, but what I'm talking about is the ETF doesn't trade 24/7. It trades during major US session, and then it's closed. So during the closure, I have had periods where a stop loss would have gotten triggered if the market was open, and then it reverses to higher. So it goes both ways. Sometimes it helps me, sometimes it hurts me. Nick, do you think silver is losing momentum, or is it just correcting in time for now? Silver, it just hasn't done anything. I mean, this chart's up and to the right. It's just taking a one-day break. I mean, there is nothing about this chart suggests to me that, it's bearish or that its momentum has been lost. This thing is just straight up. And sometimes we can psych ourselves out, right? Where we can say like, oh, it's slowing down. But sometimes you just get lower volatility uptrends, right? Like this thing could just kind of do this for a slow uptrend for a while. I think that if you want to get bearish on precious metals, if you want to say gold, silver, they look like they have downside, I think you want to start seeing levels like this one on silver. I think you want to start seeing levels like this fail to hold, right? If we break through those levels, if we fade those levels, if you start seeing this scenario, then yes, then I think you may have actually seen a metals market, top for the short run or for the time being, and perhaps we see a larger scale pullback. But I can't tell you that when that's going to happen. And what I would have to do is I would have to be following price, which means wait for those events to take place. Like if I'm looking at this chart and we see this, guys, failure at levels, then we may have evidence on the technical side for a reversal. But as it stands, zero evidence for a reversal on gold and silver for now, right? So that's where I'm at with it, is I'm going to continue to monitor precious metals, continue to just trail stops. I mean, I said this in my live stream yesterday and in my video. It's actually kind of frustrating in the sense that as a trader, I feel the desire to be more active. But sometimes genuinely the best thing you can do is to do nothing. And it's actually very hard to do as a trader because, if you're someone who's just passively investing and you look at your 401k like once a week, right? Not so hard to just sit back and, sit still. But for somebody who's active in the markets, gosh, it is, it's hard, right? To not get in here and start doing stuff. Like, do I take a partial? Do I, oh, I'm worried about giving back. I need to trail my stop right here, right? Like I said this yesterday and I'll say it again, and I'll probably say it every single day until I'm trailed out of this gold trade. The best thing I've ever done in my trading is get really good at let winners run and just do nothing about it. It's hard to do. Sounds easy. Do nothing sounds easy. It's actually hard. And some of you guys probably know this very well. In fact, I've asked on my audience many times, and maybe we can ask the audience right now, but the results to this poll have been overwhelmingly one directional. I've asked my audience, I've done a poll, which is harder to hold on to, losing trades or winning trades? And almost always the poll response is winning trades. People find it more difficult, at least when polled, myself included, I'm in this camp too. it's harder to hold on to a winning trade than it is to hold on to a losing trade. Because a losing trade, I'm like, oh, it'll turn around. I don't want to take a loss. I refuse to acknowledge it. A winning trade is hard to hold on to because you're like, I want to be proven correct. If I take profits, I feel like I've done a good thing. I'm correct. Whereas it's counterintuitive, but almost the best thing I can do for my style of trading. Everyone has their own, but for me, the best thing I can do is when a winner is going, don't touch it. Let it do its thing, and it might just keep going. Might not. And if it reverses, I'm out, right? I would love a chance to trail this stop loss. I need some sort of structure. If we get this kind of move, I'm trailing that stop. It's the first thing I'm going to do. And it's going to waterfall soon. It might. But again, I have the innocent till proven guilty mindset going. Anyways, we're going to bring in Chris Pulver to the conversation. We do have some stuff happening this morning. Let me just double check this. Let's see. I think we have Trump speaking here. What is he speaking at? Davos. Okay, yeah, he's doing the Davos thing. So markets could be really volatile. We're not going to watch it. We'll just we'll keep an eye on headlines if there's something big said. Gold is screaming into this event. Stock market is lower here. What's up, Chris?
Hey,
is
how are we
Trump
surviving?
To drop the hammer, or is he going to walk it back?
I don't know, dude. Well, first thing is, what's one of the best performing movers? Gold. That's an easy trade. Geopolitical tensions up. Looked at this yesterday. I think this is probably as clean of a chart as I can find. We talked about this the start of the year as we were just inching out slightly higher highs. I was looking at a rising wedge. Now that we've broken the structure here, price crossed over and closed below the 50-day moving average. Don't be surprised. Whether it's Trump saying anything today, there's just natural follow through. More than likely, this market finds a way to get back to like 6,500. So that could be our first real line of defense as far as support goes. Doesn't mean that I'm short to that point. Just means that's where I'm going to be patient to try to participate. Yesterday, I posted a trade for Pulver. I was actually pretty happy with this one. I did a 525 by 490. It's a ratio spread for the SPY. Collected $515 on that thing. I'm going to do that every time I see a flare up in the VIX. So what I'm curious with this year, Nick, is how many like spikes to 20 do we get in the VIX versus like one spike to 50 or 60? If we have a lot of sideways or a lot of like uncertainty, I could see the VIX hitting 20 many times this year, but not necessarily having like a VIX event to like where it jumps to 50, 60.
Yeah, I mean, I think that at least what we're seeing so far, Chris, tells me we should stay away from 14 VIX for a while. That's my opinion.
Sure.
At such a low level of VIX, I think you're more likely to get more volatility this year. So I think it's a reasonable thing to say, yeah, you could probably get a couple spikes above into maybe even to the 30s level, 30s, 40s, etc. I think that's very possible if you were to get some further escalation on the geopolitical side of things. That seems to be something that the market is not cool with right now, Chris. It seems like something we're very, very sensitive to is geopolitical stuff, tariff stuff. We saw how quickly that took place or how quickly that sold off the market in 2025. So yeah, I mean, I think to me, I'm feeling personally, Chris, a little bit more on the cautious side of the indices of stocks in general. I would love some deeper retracements. I love some pullbacks, and I'm not completely standing to the side of indices. I actually took a long position yesterday on the Japanese stock market, the Nikkei.
There you go.
I actually went long EWJ, which you know well. So I went long EWJ. I also am still long the Russell, and I think that the Russell could have some outperformance this year. I'm just, I'm still in the camp of like, I'm not willing to say I think the market's going to have some down and stay down type of year. But if you give me dips, I'm more interested in international. I'm interested in small caps. I'm interested. We've had this conversation a few times, but that's still where I'm feeling the better bang for your buck is, especially when we talk about the mags, Mag 7. We talk about the big stuff that is very expensive right now. One thing I was thinking about, Chris, is that one of the reasons valuation is tricky is that if you have really high valuation and then you have some sort of geopolitical or tariff related things, everything kind of gets treated equally. They all get sold, but stuff that's really expensive can get sold even harder.
Right.
So that's kind of my concern with markets is I think your tech stuff is little less attractive, and other areas looking a little bit more attractive.
Agree. Tech certainly more volatile, vulnerable. Similar pattern though. I mean, you could make the argument that this also is setting up for some structure breaking right here. This one almost sets up more like a broadening pattern. So I could see the Nasdaq actually making a fresh low, maybe around, this is Qs, down around like 580 to 575, which would make it difficult because that's the challenge with the broadening pattern is it takes out lows, but it doesn't stay down. So we could come right back to hit the 200-day moving average, find support, and that's where the market kind of bottoms and works its way back. Yeah. So this, look, nobody likes a down day, especially when it's the one little weakness window of like, okay, we had a Monday holiday and there's geopolitical stuff happening over the weekend, and we come in with a 1.5% gap lower, and the market held up through first half of the day and then just started to roll over around noon and finished reasonably lower. So that was one of our worst days we'd seen since the big swing in Nvidia. That was November 20th, or the big sell-off, the single day sell-off we had October 10th. It was kind of rivaling that type of move. A lot of it was gap down, but still, I mean, it was a 2+% day to the downside, and everything's looking a little vulnerable. I think structurally we have some room to fall. I wouldn't be crazy aggressive at this area. I think that do you think the market has the deeper pullback, Nick? Like just coming back to find my my rising wedge area, or do you think we come back and retest this February 2025 high?
So I think it's hard to tell magnitude wise how far I think it could drop. I think that if you're getting into, what is that to the prior all-time high, what kind of percentage drop is that?
From all-time highs to this previous one, that'd be like a 15%er. Yeah, it's like 15% Nasdaq and like 11 to 12 on S&P.
That's within the realm of normal, I would say. Yeah. I think 10%, well, with Nasdaq, you get a little bit more vol than you do with S&P. So 15% is kind of like 10% on the S&P, right? It's kind of, so I think that's within the realm of possibility within this year. I mean, especially if you're talking about, you have AI jitters, and it's weird, Chris, because it's like 2 weeks ago, we had a lot of the same story and people weren't caring about it. And then suddenly it's like the market kind of wakes up and pays attention to it. To me, the biggest thing continues to be the situation with Japan. I know everybody's worried about Greenland and tariffs and all that. And I think that is also a concerning thing. It's just a big uncertainty thing, which is triggering some of the snap selling. But to me, the more structural concern is that the Bank of Japan situation is effectively a global rate hike. Like when we think about this, when we have 10-year bond yields, listeners, I want you to think about this. The carry trade is something that has been so structurally built into high valuations across world markets. People, hedge funds, have been able to borrow money for a long time at very low rates from Japan and to deploy it into US tech stocks, Bitcoin, bonds, etc. With this move in the 10-year yield in Japan, it is effectively a rate hike because investors, hedge funds, et cetera, who are already feeling a little jittery about other things in the markets are even more incentivized to say, hey, you know what? We're getting some yield. Let's just go back. Let's undo the carry trade. Let's deleverage a little bit. Let's take some profits off the table. We've had a wonderful run on tech stocks. Maybe get back in or cover some of our positions in the Japanese thing. And we're getting, at one point, almost 4% on 30-year Japanese government bond yields. I mean, that's not nothing. And so that starts to build a case. Imagine for a second, if you're new to the carry trade, if this is a bit confusing to you in the audience, I understand. It always sounded so like a foreign language to me when I was first getting to markets, talking about, what's going on in Japan. Why does that matter? Basically, for a long time, Japan has had really low interest rates relative to the rest of the world. People were able to, for a long time, and still are, able to borrow money from the Bank of Japan at very low interest rates and then take it and buy other things around the world where they believe they can get better yield. It's sort of an arbitrage type of thing, and there's like free money in there almost. And so there's been that theme that has caused stocks and cryptos, they've been helped by this. Well, if that is unwinding, if the cost of borrowing is going up, you could get people doing the opposite, where they close positions and cover back what they owe with the Bank of Japan, et cetera. That theme to me is effectively a global rate hike. and it is something that could be more concerning than I think markets are currently caring about. That's my thought.
I listened to a session last night on Japan. I'm actually looking for ways to play not just the Nikkei, but actually some other like Japanese yen. Oh, I should say like Japanese sectors. This whole thing with the Japanese yen bond yields. So bonds are suffering, yields are going. This is what we talked about a lot last year with like global PMIs rallying, global yields rallying. The markets are kind of screaming and saying, "Hey, look, if we're going to hold treasuries, we're going to hold debt for these countries. We want more yield." The big story here is, like I think you said it really well, with like a global rate hike. This would be kind of the sign of that repatriating all dollars. The threat right now between the European Union and the U.S. is that they're going to start dumping treasuries, U.S. treasuries. I think foreign investment is up to like 60 or 63% in the U.S., which is as high as it's ever been. So I don't know, man. I mean, they're obviously everything could be escalating. I mean, we could have retaliation, but I'm still remembering what happened in 2025, which was really aggressive headlines, really scary uncertainty stuff that all of a sudden what it really did was just spurred conversations, spurred talks. I do think that ultimately cooler heads prevail. I don't think we're trying to make enemies out of the European Union. I really don't know what this. It's weird, dude. If we're talking like, okay, we're going to do this to Venezuela, we're trying to make a run on Greenland, we're talking to other countries. I'm like, what are we doing? I mean, are we going back to like 1940 something? It's like I don't understand how we can just put a pin on the poster of all countries and say like, I want this. I want this. It's right. Like that's not what 2025 should be about. I understand this, national defense race to AI, and we have no choice other than to improve our energy infrastructure and hopefully, embrace the technological future. But I don't think we could go about it or should go about it this way. Like this doesn't seem very diplomatic. So anyway, I think it's probably going to be. Well, one thing I did notice yesterday, you probably saw this too, but 10-year yields, we talk about rate of change. This is the one thing the bond market doesn't like is rate of change. And this gives us a 2-day window or actually, I guess 3-day window here. We saw the 10-year yield, which has been like this sticky instrument against the Fed's cutting rates on the short end of the curve. It's up almost 4%, Nick. It was actually up over 4% in 3 trading days. That rate of change is starting to activate some of the unfun feelings we saw during some of these big like dramatic bond and equities movements. So I don't know. I'm trying to think like, does it get worse from here? It certainly can. I'm trying to be patient, pick my battles, probably end up selling some premium if the VIX stays elevated, but certainly not trying to like, I'm not like buying this dip right away. We're only down a couple percent from the all-time highs. I'm not buying this dip aggressively. Sure. I'll sell premium, but I'm not just jumping in and saying this is going to be the bottom, because we could easily fall 5 to 7%. We could fall 10%, like you said, in the NASDAQ being more volatile. We could have a 15% correction. If you're Tom Lee, you like the dip. I like the dip too, but I'm just not all in on a little 5% correction.
Sure. Yeah. No, I think that's kind of where I'm at with it too. Is I'm still I'm playing the gold world. This has been one of the better trades that I've been in quite a while. It's been difficult because I was talking about this earlier when you first joined the stream. I trail stops and I use structure to do so, right? This is the downside of I don't use like a moving average. I could, right? But I like to use market structure. And so I'm sitting in this situation where I've almost picked up. It's sort of like if you have like 10 stocks in your portfolio and one gets really huge, you feel the need to like trim that back so it doesn't build a bunch of risk in your portfolio.
Right.
That's kind of what's happening with my gold trade. Is it's gotten so big in terms of a unrealized gain here that I'm floating the potential of giving back quite a bit if we do get a larger. So I would love if gold could just chill out for a minute, give me some kind of structure for me to feel a little bit better about trailing. But gold, silver, it's crazy because it's like you just every single day it feels like it's going up and up and up, and I don't know where the top is. I don't know how to determine where the top is. I think if you're looking for larger scale corrections, pullbacks in silver and gold, I think you'll get them. I just don't know how we're supposed to time that. And so to me, the only thing to do is what we've talked about many times with the precious metals: trail a stop, take partials, do whatever you do to manage something so that it doesn't, destroy you if it were to crash.
Mhm.
But yeah, I mean, that's, to me, these charts look broken in a sense that there is true, strong, heavy demand. And I think it kind of goes back to what you were just saying about US treasuries, Chris. If Europe is dumping bonds, if investors are dumping bonds, if people are uncertain about the dollar and they're getting out of treasuries, etc., where are they going? Well, gold and silver are kind of the spot,
For
right?
sure.
That's the
Gold
most
probably
natural
gets
place.
the upper. I'd say gold gets the upper hand. So the way that the gold and silver ratio came down aggressively, I would say
Mhm.
gold gets the upper hand.
I'm with you.
Yeah, I think silver's been a great catch-up trade. In my world, silver's officially caught up. I'm now like looking to take a bigger stake in gold.
Yep.
I still want to pull back and stuff, but gold has been, it's been a structurally solid bull run. Silver looks like it's just going to start shaking people out at some point. I mean, having 12 to 15% one day sell offs and then hitting fresh all time highs. Um, again, I don't know where the top is, but this is a measure move top. We had a blow off since that's a $49 high and it's already at 94. Again, both are good in my opinion, but I think ultimately it's going to feed into gold because that's where like the net long position is, and that's where most people are looking to, have the physical like hoarding build out is going to be. I want more gold.
Yep.
Um, I don't know. I don't know. If one thing Trump is good at, he's good at escalating everything. So if this is going to be a flee to gold and a really aggressive move against bonds and treasuries and against the fiat system, gold's probably going to be the ultimate beneficiary. It's like I think right now with Bitcoin being a little bit down and stepped on since last year. I mean, gold emerged as the GLD ETF is the outperformer of the last 25 years. It's outperformed the SPY, and it wasn't until the last couple of years that it eclipsed it, or it clipped it. But fact of the matter is, 25 years of trading, GLD is the best performing ETF over the SPY, which is
Yep.
crazy to me.
Yeah, it
But it
is
is.
absolutely crazy. And
Yep.
it's one of those things, man. It's like the oldest real money thing in the book. It's 5,000 years of gains. Anyways, I want to show you another chart here, just going
Okay.
off of our conversation, this drive into gold. The real yield history chart here is something that I think really, really matters. Like I've been thinking about this more from a macro perspective. How do we know when gold and silver are topping out? And price clearly, technicals only, clearly seem to be missing something because it has been overextended for like 2-3 years in a row now. I mean, it's just been continuously overextended. So technicals may not be giving us the right guidance in terms of when the trade is over. But one thing that I think is worth watching is the real yields that investors are getting. This concept, right? We have elevated interest rates globally, where we're seeing yields rise in Japan, in the US, in Europe, UK, list all of them. They're all going up. One of the concerning things and reason I think gold is getting such a flood of investment is because when we take into consideration, let's look at Europe, right? If you're looking at Euro, inflation in Europe and interest rates are about the same. So your real yield is effectively nothing. You're not getting any gains for investing in European bonds. You're just kind of hedging out inflation. In the US, you're still getting some positive, but look at the trend. We are seeing a decline in real yield when investing in US bonds, et cetera. So inflation has been kind of sticky to the side, and then interest rates have actually been gradually coming down. That is producing a less favorable return. Now, bear with me. We'll do one more. Take a look at Japan. Japan is improving to some extent, but still not great, right? You still have CPI somewhat elevated in Japan and interest rates just very gradually coming up. So this is actually in the negative. By holding Japanese bonds or yen, you're effectively losing value by holding that position. When we look at the UK, right, real yields topped out 2024, August 2024, and have been declining. Yes, inflation has, kind of come down from those extreme levels where we were getting terrible real yield, which, by the way, gold did really well in that environment too. The point is the direction of real yields seems to be trending lower. Why does that matter? Well, bonds and gold are essentially, they are competitors in some way. For the sleepy boomer investment kind of crowd, where do you want to park money if you're looking for something relatively safe? Well, bonds are attractive if you get a nice real yield. If you hedge out inflation and you return something positive to your portfolio, bonds start to look pretty attractive. But if we're seeing that kind of slashed where real yield, you're not getting anything, you're just barely hedging out inflation, and that could continue to go negative where you lose money in bonds due to inflation. Bonds are out, gold is in, because gold, one of the biggest criticisms of gold is it doesn't yield you anything. It's just a rock. So you're just holding on to a rock. So when we talk about this though, but if you start comparing it and you say, well, bonds don't give you anything either in actual value, then gold starts to look really attractive. So I think if you want to talk about structurally, where does gold get a real sell-off? It's when this story reverses, when bonds start to look really attractive. How do you get bonds to look really attractive? When inflation is relatively under control and yields are up. And, that's where you actually get some sort of positive return, and we could see cash flow back into bonds. But for now, with high national debts and tons of printing and uncertainties around rising inflation again, and all this geopolitical stuff, gold is just running hot on this story.
Yeah, I think that's what also feeds the narrative is, because ultimately it's like we're like the U.S. right now, we pivoted, so we're trying to grow, right? We're trying to grow through this higher inflation. I just took a look at this. It's like, this has been a great trend. I mean, whenever we see the next CPI print, it should be better. I hope like this is an encouraging sign. There's tons of data points here to get this 1.42, which has been straight down from 2.7. So inflation is improving. That's a good thing. But I do think that the one guarantee you have is if I was to take a trade and be taking a calculated risk on, do I think the governments around the world will print more money? My certainty on that is like 100%. Yeah. So gold is getting a lot of love for that. And I think that's what is fueling this move. And it's not just, the stealth central bank buying or the stealth, like, People's Bank of China buying. Like, this now has been kind of blown open as like everybody sees this playbook is happening right in front of their very eyes with the type of performance we saw in 2025. Again, expect some wild and crazy pullbacks just because of the technicals. I hate it. Like, I have a gold position. I'm enjoying it, but I'm not nearly as heavy as I was. I mean, I closed a 3-year campaign trade down. I'm not heavy back into gold. I wish I was. But point is, I still want to add more to it. Gold to me is going to be, the better of the two at this point, since silver kind of outpaced it last year. But it's I would hate to see gold, hit 5,000 and not stop. I'd love to see that. I mean, percentage wise, I think we're now 20% away from the 200-day moving average. 21. And I mean, if this creeps up here, Nick, with like a really aggressive rip, and we get to close to 30% stretched away from the 200-day moving average, I would call like a near-term technical top. Doesn't mean I want to short it necessarily, but I would say if we're 30% overstretched, technically that's probably due for a pullback. Well, I don't know. We'll wait and see. But just seems like this simple trade right now is buy gold and the hell with everything else. Like, let it all figure yourself out, whether it's choppy, volatile. There's even some smart people making cases that even trading non-US, like, dump the S&P and just trade non-US, which I don't really agree with that. I think that if you're just a percentage allocator, then sure, I could see, a lot of foreign investments outperformed the US last year. But when you sprinkle options into the mix, you can amplify returns trading options. US markets are better than almost every other market out there for options just because of liquidity. So it's hard for me to turn down, the US markets when I can sell so much premium and do well.
Yeah, I agree with that. Chris, natural gas is up 22.7% today. What is going on this chart?
Well, that's good. Crazy. It's about freaking time. I have calls on UNG that are in the money. I did like a $5 call. I'm looking to see if this will just make a run. I'm not even trying to hold this, So 2 instruments I called a widowmaker: natural gas and the Japanese yen. They will make fools of us all if we're not careful. So I do have a long call position, and I was treating it like a diagonal spread, which is I buy the really like deep in the money call, and then I sell against it so I can lower the cost of my trade. So my break even price is around, I'm trying to think, like $13.
Yeah.
So I just now got back into profit, but if you see the chart, I'm trying to look for a flare up into like the 20s again, and I'm just going to take the profit. I don't know if this is something sustainable. I mean, I truly will miss out on this trade if we end up going into this area, which is what I kind of thought, well, hey, this this need for natural gas, but I just think it's so plentiful right now. There's so much supply of natural gas that it's like, I don't think this thing ever amounts to much more than like a pop up here to 20, and then it just resets. I don't know. I don't know. This is a very complicated instrument to trade, but if there's anything going from natural gas into the 20s again, I'll just take my profit and move on. But I've got until I've got January 2027 expiration. So if we have anything positive this year, I'll be profitable.
Natural gas, it is certainly a volatile one. And you know, same thing with like oil, et cetera. There's that infamous, you know, hedge fund dude that blew up trading natural gas futures. You know what I'm talking about? If you've seen that video, he
I don't know, Dave Portnoy. No, I'm just kidding.
No, there's like this big hedge fund dude. There's a video on YouTube where he made like an apology video, but basically he like blew up a bunch of funds, and it was all on, you know, selling out of the money, you know, natural gas stuff. And it all got hit at once. I think he was selling calls or something on it. But anyways, yeah.
Speaking of blowing up accounts, did you hear of Captain Condor?
No.
The guy that was, he was this. So this is a guy last year. I think his name was David Chow. He ended up amassing like $50 million in subscriber like following. It was like $50 million bucks, and it was basically I do a similar strategy, just not the crazy martingale that he was doing.
Right.
He was doing basically an iron condor on the SPX.
Yep.
And that means that you're trying to trade in a range. So if the SPX opens, let's say it opens up here for the day, he's selling calls and he's selling puts, and he's looking for a range trade for the day to collect the income. Now, over the holidays, turns out that I believe he took 5 losses in a row. And what's funny is I run a service that I do this every single day. And we acknowledge that during the holiday stretch, like late in December, I started to notice almost every single day was a non-efficient day, meaning that the market makers kind of set these highs and lows, and the market was breaching those like 5 out of 6 days in a row. And I think it ended up being like 7 out of 10 days, the market went through the expected move. And so in that stretch, okay, guess how much money he lost?
The whole thing?
The whole thing.
My God.
He martingaled to $50 million, had it all riding, and on one little holiday day, he blew up the entire account.
Crazy.
So anyway, it's like, that's risk. And I'm sure there's, you know, unfortunately, there's probably lots of David Chows out there. And unfortunately, there's a guy that blows up a natural gas fund or whatever it is. Risk management is the only thing that's going to help you survive. But like, it's not a bad strategy. It's just terrible risk management. When you double down, some of the trades, I look at gamma levels all the time, and I would literally see like some of the trades for his followers. And so him and his followers, they had big enough positions where they were actually on the gamma charts, and they were bigger than like the JPM collar trade. They had like, you know, sometimes 40 to 50,000 contracts in SPX. So, you know, it works until it doesn't. And obviously the martingale is exactly that. It works until it doesn't.
Well, and the thing is, it's like you said, there's nothing about that strategy that is inherently bad, right? It's that how much size you put on stuff.
Yep.
Like for anyone listening, like I want you to, sometimes people get so enraged when I say, like, if you can make 2, 3, 4% a month on average per month, like I said, over time, that is incredible returns. The reason, and that by the way, Chris, you know this probably well, when you talk about those sort of returns, like you and I, they're like, if I could sit back and make 3, 4% per month, I'm gonna be rolling in it over time.
Yep.
That's an excellent return. The issue is that when new people hear that, when new traders hear that, they're like, 3, 4% on my $1,000, that's not going to do anything. So I don't, you know, that sounds like way too low. I think I can make 10, 15, 20% per month. Well, you can for a while, but the problem is every strategy goes through a stretch where something breaks, where it just doesn't work, like really, really bad. Every single strategy, you cannot pick one that does not have a period of time where you're like banging your head against the wall and you're like, this thing just keeps losing.
Yep.
Every strategy, trust us. Chris has been in this for 20 plus years. I've been doing this for 10 years. You cannot find a strategy that is invincible. So with that conclusion, okay, there is no impervious strategy. The only thing, regardless of which strategy you pick, that will keep you above water long-term is small sizing. Risk management is absolutely everything. And so that's why 2, 3, 4% per month on average is phenomenal, is because when you actually size down to account for that inevitability, you are not going to generate 10, 15, 20% per month. without very high risk of ruin or the chance of blowing up.
Yeah. And, like I mentioned, I run a service that does something very similar where I trade SPX every single morning. I had followers that kind of had a similar path, not in the martingale style, but like, they follow me, we take good trades. They put the profit ahead of the process. And to me, what I saw was, over the course of, let's say 60 days, one of my followers made like 25 grand. Loves it, very vocal in the chat, doing this stuff, love this trade, love this thing, favorite strategy ever. And then he takes a 1-day loss of like 10 grand.
Yep.
Immediately, what does he do? I don't think I can do this anymore. It's too stressful. Blah. It's like you went 60 days in like 60 days solid with like a 90+% win rate, and you let 1 day, now all of a sudden you're going to throw the whole strategy away. It's like, it's about size management.
Yeah,
that's all it is. Like,
and just turn down your dial.
Yes,
you can amplify. You can turn that speaker to 10, and it's gonna be loud. And what I'm referring to is, as you're pointing out, his size was huge, so he loved it when the music was booming and it was great. Right. But
yeah, everyone likes to win. But I mean, if you're not prepared, what it feels like on the other side of that table, when it's like you're the losing party, it's like that's when the emotional side will make you really make terrible decisions. So I mean, I get it. Like, it's nice to have a run of 25 grand in a 30, 60-day stretch. But if making that $25,000 comes with like a $5,000 to $10,000 to $15,000 swing,
yes,
dude, I'd rather be up 5 grand and swing $500 swings versus be up 25 and give half of it or more of it back. It's like that. That is an emotional roller coaster ride. So I'd rather be I don't know, man. I'm the tortoise. I'm just the small, like, base hit, and like to keep the equity curve pretty silky smooth. There's always good trading opportunities.
It's very tempting to be greedy, and that is a very true fact too. Especially when you're new to this stuff. But I think actually, last thing, and then we got to go. Last thing here is that it's very tempting to be greedy, but once you experience the burn, once you get burned by the stove, you actually have, in my opinion, experience. It is more attractive to avoid the pain of getting burnt like that,
loss aversion,
than it is to have that upside of like, a really great win, right? That losing streak, that pain of drawdown is way worse, like way more emotionally stimulating on the negative side than a good win streak. So to me, it's like, I'd rather avoid the super negative and take smaller gains.
For sure. And, loss aversion is very real. And a lot of people will do everything they can to never feel that pain again. The problem is they felt it, and they probably, did a lot of damage to their account and finances. And yet now they try to avoid it. Yes. So, the hard part is we tell people, it's like, look, it is about risk management. It's about survivability. And people don't really listen until, Tyson's saying is you get punched in the mouth. So when the market does that to you, then you listen. But if you could avoid that up front and just trade boring. I mean, honestly, it's like, it sounds silly, but the only reason I've been doing this for 20+ years is because I do trade boring. And you're talking to somebody that ran a currency fund with 100-to-1 leverage, and I traded boring. I literally traded micro lots and mini lots and built up to standards on positions that I liked. It took months and months and months of planning and preparation for those type of trades. And I would sit and make no money for like months at a time. And then I make like 10, 15%. So it worked, but it's like the amount of patience and discipline to like not trade large and let the market swing and not use stop losses in currency trading, which is sometimes a little iffy, so.
Well, and again, sizing is everything. Every strategy can be dumb or great, but sizing is imperative to surviving. All right, that's it. We gotta move on. Chris has got to go. I got to go. See you, Chris. Thanks.
Have a good day, Nick. Thanks.
Bye. All right, guys. Up next, we have Marco tuning in here. He's going to be taking over the stream for a little while, and he might be doing. I'm not sure. He may be doing some giveaways to today's video sponsor, DNA Funded. So stay tuned on that. Either way, he'll be sharing some ideas and things that he's watching in the markets right now. Before we go, last thing I'll say is if you guys are interested in joining our VIP group, if you want to get trade alerts from myself, Marco, and Chris, all of that is something that you can take advantage of right now. Everything is 40% off in our store right now for VIP memberships. If you want to join us inside of the Discord, take advantage of that. Here's how you can get some information. We'll drop a link here in the chat to where you can speak directly to a member of our support team about the 40% off sale right now. Don't hesitate. Send us a message. Just let us know what you're looking for, and it might be the right group for you. We've taken a lot of traders to the next level, and it is a group of serious people taking things to the next level together. So with that said, here comes Marco. Stay tuned. Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show.
Hello everyone, welcome to my segment of the live stream. I do have some codes to give away, so don't go anywhere. I will give away a code in 10 minutes. So in 10 minutes, you'll get a free 10K one-phase DNA funded challenge. The fastest hands will get the code. So looking at the markets, I'm sure Nick and Chris have already talked extensively about what is happening. So we're going to do a brief overview of what I have. By the way, a new trade that I'm in is USD Swiss. So bought the lows of this range. Just want to go through this position because I'm pretty happy with it. I'm pretty happy with the level. Let me tell you the reasoning why I took this position. So first reason, Edge Finder, top setups, USD, CHF. Getting a neutral reading now, but yesterday, if we go to the history, yesterday it was a bullish reading. So if we jump onto the history, you can see yesterday we actually got a bullish reading. So that was the main reason for taking the setup. Second confluence. So the second confluence was the technical analysis behind it, where we were at a crucial level of support. So we had 1, 2, 3, 4, 5. 5 times we have rejected this level, pretty significant level. Third confluence, third reason was a taco trade. So taco trade, Trump always chickens out. What does that mean? Well, Trump goes into the markets. He has a crazy announcement, crazy tweet. This one was a 10% tariff on some big European countries. So like 6 or 7 European countries. So let me show you that announcement. If you go to the market moving, actually it's not going to be here. It's going to be, could we search up for a tariff? Let's see. Does that work? We got a delay, by the way, for the tariff ruling from the Supreme Court. So that's kind of a nothing burger. That turned out to be a nothing burger. But if you scroll a bit lower, yeah, we're most likely not going to find it. Again, it was a 10% tariff on some, well, one of the biggest like European Union countries. Anyway, let's remove this. Get back to what we want to see, which is Forex. Trump, we are seeking immediate talks on Greenland. So, okay, looks like that was bullish for the dollar, bullish for the S&P. It printed a couple of minutes ago. Interesting stuff. Anyways, so the third reason, taco position, Trump goes crazy. Markets move a lot. In this case, USD Swiss crashed by, let's see, minus 1.6%. And then a couple of days or weeks later, Trump eventually walks back on his word. So the markets return to the previous level. It's a sort of a mean reversion position. That was the third reason. Fourth reason, positive swaps. So if you buy the USD Swiss, it is really good because you get a daily income with positive swaps. How do I know that? Because if you go to your Edge Finder and you go to, let me see, I think it's interest rates. No, it has been moved actually. It is the carry trade scanner. Carry trade scanner is the CHF. You go to USD Swiss, Carry direction is a buy. The interest rate divergence is pretty high, so the divergence is 3.75%. That is pretty massive. So if you buy the dollar Swiss, you get positive swaps. How many or how much positive swaps? If I check on my broker, I can tell you right now. So if I go to my IC markets and I search up USD CHF in MetaTrader, and swap long for me 6 euros. So for every one lot that I buy, I receive 6 euros every day. Okay. So that's not bad. You know, it's much better than negative swaps, and it's a bit of an extra income. 6 euros per one lot for doing nothing. I like it. So that's another reason to buy. And maybe the sort of the final reason is Swiss central bank. They would maybe want to defend this level. They are known for doing interventions. They are similar to the Bank of Japan. So to keep the price of the exports low, to keep Rolex watches cheaper for Americans, they may want to defend this level. They may want to buy the dollar, sell the Swiss, and not really allow for a break of this level right here. So many different confluences. I really like the position. Stop loss is at 0.78124. Entry is at 0.78891. Take profit not yet set, but I'm mainly aiming for the top of the range. So it's a bit of a sort of a range bound play on the daily chart. Buying the bottom of the range, selling at the top. That is the current game plan. Or at least I want to see the price go back to the initial level before the sell-off. That's the minimum I want to get. And even if just that happens, it's a positive reward to risk, which is always nice. So I'm always aiming to have a positive reward to risk in the markets. So that's the position I'm in. Pound Aussie looks very juicy. So Pound Aussie broke a key level of support. Moves are starting. Thankfully, the markets have woken up. That's exactly what we need. We need moves. We need volatility. And that is what we can spot at the moment. So break of support. Big red candle on the daily chart. I think the edge finder is still producing a bearish setup, but I will take a look. Pound Aussie, yes, we're still getting a bearish reading. So now I'm looking for a retest. I'm looking for a bit of a pullback, retest of this level. It's game on to look for sell setups, tight stop loss. Of course, I don't want to have a huge stop loss in the market. And that's going to be the plan. So let's put a yellow flag on Pound Aussie. If you're in the A1 Discord, you will get notified about all of these setups. So you already got the signal for USD Swiss. And if I decide to take the Pound Aussie, you're going to get a sell signal. If you want to join the A1 Discord, if you want to get all of my trades, all of the trades from Nick, Chris Pulver, iWind, and analysis from Alan, definitely consider clicking the link in the description of the stream and use the code Marco. So code Marco gets you 25% off on the A1 Trading Discord and on the Edge Finder. So check it out. Now, gold, it's the last thing on my watch list, so I want to cover it just before I do the DNA fund giveaway. As far as gold goes, I want to buy it, but it started flying higher. So gold definitely started to explode higher. We are now too far away from the 20 MA. Looks like we will not get a pullback. Yeah, I just don't think. I'm definitely not going to be buying at these levels. If I flip to silver possibly starting to slow down a bit. That is an interesting development. So silver seems to be slowing down a bit. Just a second. Okay. Gold has gone too far. Let's put it in the edge finder. Gold, neutral. What about silver? Neutral as well. That's interesting as well. So I usually want to take setups that follow the Edgefinder. Edgefinder is one of the main confluences of why I buy or sell specific assets. So for me to buy gold, I would not just need a pullback, I would also like to get a bullish reading on the Edgefinder. So I sort of have two criteria that need to be fulfilled before I can get in this market. But it's absolutely on the watch list. We are in a major risk-off environment. Massive spending, massive printing is expected in 2026. Trump's big beautiful bill comes online. New Fed chairman, cutting interest rates. That's all bullish for gold. And the whole uncertainty that we have around Venezuela, Iran, Russian oil tankers, Greenland. Greenland now is kind of the main thing. And the more drama you get around Greenland, the more bullish gold will be. So that's what you can expect on gold. So now for a general situation on the markets. Or sorry, time for the giveaway. Almost forgot. So giveaway, DNA funded, 10K, one phase account. I have checked the code, and this time it's not an old code. So I'm going to give you a fresh new code. I screwed up the last time, but this time I'm prepared. So 3, 2, 1. This is it. So T0, or is it the 0 or an O? I think it's a 0, QJ3TTX. That's the code. If you didn't catch the code, there's a discount A1 Live, A1 Live, which gets you 25% off any DNA funded challenge. So if you have used the code, put it in the comment section so that we know that the code has been used. If you didn't manage to catch the code, but you want to get funded, A1 Live, 25% off. So let's take a look. Did anyone use the code? Got it. Pixel Winscom. Awesome. Code for what? So the first code is for a free DNA funded challenge. The second code is for a 25% discount for any DNA funded challenge. So for one phase, two phase, rapid, instant, 5K, 10K, 25K, 50K, 100K, 200K. So yeah, this is the DNA funded website. Just go through the process, go to the checkout page, put in A1 Live, and it's 25% off. So congrats to Pixel. I do have more codes to give away. So make sure you tune into my segments, tune into my streams, because I have a couple more 10K accounts and I have one more 25K account that I'm leaving for the last giveaway live stream. Okay. Continuing with the regularly scheduled program. And I'm not logged into my personal DNA funded account, so I can't show it to you today, but I'm going to bring it up tomorrow. So I do have a personal 50K DNA funded account. That is unfortunately in drawdown, but I think the S&P is starting to go up. Yeah, starting to push higher today. So at least that's good. That's because I'm long on the S&P, so on the DNA account. So that's good. General movement in the markets. Let's see. So S&P up on the day. NASDAQ up on the day. US 30 break even. Russell up. DAX going lower. So the DAX is actually right at a support level. I don't believe the Edgefinder has a bullish reading, so I'm not super... It's actually a bearish reading. Yeah, I'm absolutely not going to buy the DAX here. Massive sell-off. Edgefinder is bearish. The only sort of bullish case is a breakout out of the range and then a retest of this massive level of support. Again, resistance becomes support. So the DAX, I'm not watching at the moment. Nikkei actually performing pretty well. I know Nick took a buy position on the Nikkei, which is pretty good. Let's see the Edgefinder, Nikkei. Bullish reading, that's awesome. Uptrend. The PM of Japan is super dovish. The BOJ in Japan is dovish as well. If you look at what they're doing with the interest rate, so that's gonna be in Interest rates. No, sorry, it's going to be under. Real yield heat map. Yeah. Okay, that's it. So look at Japan, JPY. Look at the interest rate that the central bank sets. Look at the CPI. The real yield is negative. So they definitely don't want for people to save money in Japan. They want people to spend. They are super dovish. The real yield is still super negative. So that is interpreted as massively bullish for the Nikkei and massively bullish for the Japanese 30-year bond yield. So let's take a look. I know Nick made a video about it yesterday, so watch it on his channel because it's a very interesting video. JP 30-year. Okay, retracing now. Retracing at the moment, but look at this. We almost touched 4%. Does this look like a normal bond yield curve? It definitely doesn't. It looks like a massive problem for Japan. It looks like a massively dovish policy in Japan. It looks like investors are completely fleeing from Japan and they don't like what they're seeing. I also think if we look at the economic data, inflation, CPI, and if we go to JPY, it is going to be way above target. So the inflation print in Japan, 2.9%, that is a big problem. That is a big issue. So Japan, not in a good spot. But the stock market, the Japanese stock market seems to be loving the current environment. So that's it for the indices. I'm not looking to buy any of them at the moment. I'm just focusing on gold because it's still a pretty risk-off environment. And the taco trade, I want to execute the taco trade through USD Swiss. So I know there was a lot of talk about the taco trade. Well, I'm doing it, but I'm doing it through a currency. I'm doing it through USD Swiss. Silver, parabolic, I don't want to touch it. I definitely don't want to sell it, but I'm not going to be a buyer. I think this looks overextended, and I think gold offers a much better opportunity. Platinum, copper, not that interesting. Bitcoin, is Bitcoin really moving? No. So it tried to go higher. We tried to see a push higher. Tried to go above 100K, but couldn't do it. So couldn't do it. And now there's a big sell-off right here. So Bitcoin still looks flat, still looks problematic, still looks range bound. I'm not liking this. I'm not liking this position. Ethereum, same thing as for Bitcoin. Until Bitcoin wakes up, until Bitcoin goes back above 100K, I don't want to touch Bitcoin. I don't want to touch Ethereum. What about US oil? Moving higher, actually. This is probably because we have some geopolitical tensions, especially around Venezuela. So we're going to see what happens. And Venezuela and Iran. Iran is a big player, of course, in oil. And if you have any tensions around Iran, the oil prices are going to continue going higher. DXY sold off quite aggressively, now starting to pause a bit. Will the sell-off continue? We will find out, but currently, at the moment, we don't have any evidence that the sell-off won't continue because we, as far as I'm aware of, we are not getting any positive news, which is a problem. If we get some positive news, if we get some walking back from Trump, so if Trump becomes a bit more, how would you say, a bit less aggressive, then the dollar should start catching a bid. Because fundamentally, the United States are in a pretty good position. So if you go to economic heat maps, US, and you go to, okay, that's it, US, you're going to see it looks all right. So 58% of the data is coming out better than expected. So fundamentally, the dollar should be catching a bid. In my opinion, from my analysis, the dollar should be catching a bid. But of course, because of Trump, the dollar sold off. It's so we're going to get a resolution. We're going to get a resolution of the current situation, and the dollar should, there's a very, very high chance that the dollar goes back to the initial level. So that's it. That's what I'm watching for. JXY, I'm kind of leaving it alone for now. Let me check out USD JPY. I was betting on an intervention on UJ. Now we're sort of slowing down a bit, so there's no need for an intervention at the moment. US bonds flew higher, so broke a pretty significant level of resistance and went to, what is the high? Went to 4.3%. That's pretty aggressive, and now started to sort of pause a bit. So we're going to monitor what happens with the bonds market, but Trump definitely broke something again. It is kind of the repeat of April, but on a much smaller scale. What is the repeat of April? Well, that is stock market down, dollar down, yields. Well, yields actually in April, I think, no, yields went up. Yields actually went up in April. Yeah. So that's usually what happens when Trump messes around with tariffs. Okay, I do have a few more minutes. So let me see the comments. Let me see what you guys want me to break down and bring up on the charts. 6-7. Can we take a look at gold? Pound Aussie left without me. I mean, I do like the Pound Aussie. I do also believe we could get a pullback to the support level. That's where I'll be stalking the price. So I'm looking at this level of its resistance now, but I'm looking at this level to try and get in on a short position. So I still believe the Pound Aussie is in play. Orange Man is speaking. Yes, so we should see that on the Forex Factory calendar. Let's take a look. No, we don't see it. We do. So World Economic Forum annual meeting, President Trump speaking. He started, I think, an hour ago, and looks like it's still going. So yeah, the markets aren't really reacting to his speech. If you zoom in, there's not really a huge candle on the 1 hour chart. So we don't really see any massive developments as far as the dollar goes. Marco, we might have a pullback today, says Max. Trump says he will not use the aggressive way. Well, that's good. That should mean that he's starting to possibly walk back on his word. And that's exactly what we want to see. Does anyone think that Trump is intentionally orchestrating these pullbacks? He's just doing what he wants. He thinks he's going to do a deal. He's the deal maker. So it's just his style. You know, he goes out, he posts a crazy tweet, he does a crazy announcement, and then everyone overreacts, and then he starts walking back on his word. He breaks the financial markets, but hey, that's good for us because it brings in volatility. And as long as there is volatility, there is going to be opportunity. Marco, hello. Can you check the gold to silver ratio chart? Gold to silver ratio. Yeah, just a second. No worries. Okay, I'm gonna keep doing the stream for a bit longer because I think James FX is coming on after me. He's gonna be a little bit late, but that's fine. Let me just take a look. Yeah, so James is gonna be here, but he's gonna be just a little bit late. We're gonna continue with the requests. BTC to gold ratio, I think that was the request. This is it. So again, this is a clear risk on, risk off ratio. Right now, I mean, in my opinion, we seem to be in a risk off environment. Okay, let's see, minus Can we do years? Let's do 2 years. Okay. Yeah. Trump, I won't use force to get Greenland. That's great. That's definitely a great post. Ukraine-Russia war is averaging 25k deaths per month. I know it's horrible, and it seems like it's not going to stop anytime soon. He's a businessman. You always oversell your deal, then accept smaller. Yeah, that's his style. So Trump comes in, crazy announcement, crazy tweet. Markets overreact, people overreact. Then Trump starts walking back on his word, and then he completely walks back on his word in the end. So, so it's a taco trade. Trump always chickens out. Yo, Marco, did I miss Trump speaking? If not, at what time will he be speaking? He started an hour ago, and I think he's still at it. NZD Swiss. I'm not in NZD Swiss. I am in USD Swiss. NZD Swiss, I'm not looking at the moment. I know it's getting a very bullish reading on the edge finder. So if I go to top setups, NZD CHF, very bullish. So that's great. That's an awesome, massive confluence. But NZD Swiss just doesn't look so great in terms of the technical analysis. And there's no taco trade on NZD Swiss. I much prefer dollar Swiss because the edge finder was bullish, because I want to buy the low of the range, I want to target the high of the range, and because of the taco trade. Trump says you can give us Greenland and we can be appreciative, or you don't and we will remember it. I don't know what to say. It's pretty funny. If we didn't have Trump, it would be so boring. So at least we have a pretty entertaining US president who moves the markets and who gives us traders some awesome opportunities. I mean, if it weren't for Trump, we would probably not get this massive move lower, massive crash. And if you were watching the markets and if you knew a little bit about trading, you would have bought the dip and it would have been a massive, massive play. You would have made massive percentage. Up to now, 32%. So James is here. Thank you very much for watching, guys. I have more DNA funded challenges to give away. So join me tomorrow, join me on Friday, and join me next week. Thank you for watching, and I will see you in the next live stream. See you. Goodbye.
Hey stream viewers, if you're outside of the United States, I have a cool offer I want to tell you guys about thanks to our partnered broker, 8cap. 8cap is currently offering the ability for new depositors to get access to our premium tool, the Edge Finder, completely for free. Now how this works is basically you create an account and deposit a certain amount of money into that account, and they will essentially buy the Edge Finder on your behalf. So it's a win-win-win. They get a new client for a reputable brokerage, you get access to the Edge Finder and a great brokerage to trade with, and you'll be supporting the show by signing up with 8cap. Now here are the steps if you want to find out more about this specific offer, but make sure to follow them specifically as we list them out on the screen here. Step 1, navigate to a1trading.com/8cap. That's a1trading.com/8cap. Step 2 is to follow the instructions and to make sure you use the specific link on that screen to sign up for your new 8cap account. Step 3, complete the required deposit amounts and contact their team as instructed on the page. So if you're interested in finding out more about this offer, head over to a1trading.com/8cap, and we'll also be dropping the link to this down below in the live stream chat as we speak. Like I said, make sure to follow those instructions specifically if you'd like to get access to a free copy of the Edge Finder if you meet the deposit requirements as listed on the website. Full information, like I said, can be found a1trading.com/8cap. Now back to the stream.
Hello. How's everyone doing? Happy Wednesday. Happy hump day, halfway through the week. Hope you're all good. Hope you're all well. Chris wants to see metals bleed just a little bit today. Why is that, Chris? Is that so you can get in? I know gold's had a crazy run. So is silver. Very, very sort of parabolic move. So yeah, I was looking. Hold on, I've just got Trading View back, so I'm a little bit rusty on the shortcuts or whatever. But yeah, no, I was looking for this. So obviously, if we look here, we've got the previous high. I suppose I don't need to use this either anymore. Hold on, let me get the actual brush tool. So yeah, we had the previous high here. I wanted to see the retest. You know, I'd love to see a break, which is what we had. The come back down and the retest, which again we had, and this also lined up really, really nicely with the 50% fib. Now, this was, I actually can't remember what this was. Was it when Trump was talking about Powell? I can't remember exactly what the situation was on this candle, to be honest. It was something along those lines. We came in, tapped in, but I just couldn't get the entry. Obviously, it was quite a volatile move at the time. So I didn't really want to risk it just in case the market decided to continue to run lower on that. But yeah, it was a little bit disappointing. So actually, I can sort of scrap all of this now. But yeah. Buying level for what? Jeremy, good to see you. Yoshi, hello. So yeah, I mean, I think it's pretty simple. It wouldn't be a shock to me actually if we see gold come back down. Hold on, let me get rid of this magnet. Gold come back down to fill this gap. It's very common that large markets, liquid markets like gold, euro, dollar yen, etc., generally do come and fill gaps. It can really vary on time horizon. It could be within the hour, could be within the day, could be a couple of weeks. I mean, look at dollar yen. We've still got the gap on dollar yen from the election. Hold on, let me pull this up for you. Yeah, all the way back here. So this gap remains unfilled. So that's what I mean. It can really vary over time. But I would expect that to get filled, which could be an opportunity to get long gold if you're not already. I'm quite disappointed. It seems I've really missed the rally on this one. But there we go. It is what it is. Shills, hello. Cycling. Yeah, I'm good. Thank you. I'm good. But yeah, I mean, in terms of trades, I've got a couple of things I'm keeping an eye on. I went long on pound Aussie. Sorry, not long. Went short pound Aussie yesterday. Was it yesterday? No, Monday. Sorry. So yeah, this was quite nice. We were looking at pound Aussie last week together on stream. And I was saying, actually, I didn't really like it too much because I wanted to go in for Euro Aussie instead and Aussie New Zealand. Now, as obviously the weekend developed, we got news from Trump and Greenland. We had a little bit of a development there. I was reconsidering my all the correlations and the exposure. So this is where you'll often see some traders slip up. They'll have an idea, you know, whether it be buy dollars, sell euros, Australian dollar, New Zealand dollar, whatever it may be. And they will just go in, they'll go for the strongest and the weakest currency, which typically is like obviously the best idea. That's what trading is, essentially, or trading currency pairs at least. However, if we obviously consider the situation that we've got with tariffs and obviously the general uncertainty in the markets, the euro makes up a large portion of the DXY basket. So if I went short on Euro Aussie, that would have given me indirect exposure to the US dollar, which means that the position was exposed or had the potential to experience more volatility or more irrational moves than pound Aussie. Now, obviously, that's not a direct thing. That's not a case of, you know, Euro Aussie could rally and pound Aussie could completely collapse. That's not really what I'm saying. It's just a case of minimizing the risks of the trade. So I decided to pivot slightly, although I'm not as happy with pound Aussie as I was with Euro Aussie. It was just that thing. I made a little bit of a sacrifice. But yeah, anyway, let's move on. So we were looking at this market, and the reason I decided to go in was not just the fundamentals, but we also have the technicals here with obviously the support level. Really nice previous high here, obviously previous low, drew the fib from high to low, and then we saw the pull back into this fib 50%, excuse me, 50% level, rejection quite a few times. Then we managed to get in on this bearish H4 engulfing candle, which was really nice. And of course, we do have a really nice downtrend as well with the 50, 200, and the, wait, hold on, I'm not even sure what EMAs I've got actually. Like I said, I've only just got back to Trading View. Let me just make sure my EMA settings are actually correct. I'm fairly sure it should be a 200, a 150, I think. So we've got 200, 100, and a 50. Yeah, that's fine. So yeah, 200, 150 moving averages, all in a bearish trend as well. So the trade technically was completely fine. We Also, is it still there? It's not actually. Oh, it is. Sorry, bearish here. Let me just show you the page for pound Aussie. Yeah, there we go. So, yeah, overall, bearish reading. We have got COT that's not really doing too much. Although I don't really pay much attention to smart money or the COT sentiment. I do, generally speaking, but I'm not going to base a trade purely off that. I wouldn't take I wouldn't avoid a trade because of COT, but I also wouldn't take a trade because of COT. I account for it and what the trend is and the situation, the context. But in this case, it doesn't bother me. Hopefully that made sense. Now, the really nice thing is retail's been almost 90% long. Obviously, you know, one of the easiest ways to make money is counter trading retail. Obviously, easier said than done, but that was good to see. Seasonality is bullish, but again, seasonality, as I say quite often, isn't something I pay much attention to unless it aligns with the current fundamentals. Fundamentals first, then seasonality, in my opinion, because obviously seasonality is historical statistical moves. So as we see over the past 10-year average, I'm not sure if this is by month, but I would assume so. We can typically expect an average of a 0.61% increase in pound Aussie price. However, the fundamentals are just not there to cause any large buying on pound Aussie, in my opinion. I just don't see that happening. So in this case, I write off seasonality because it just doesn't play much of a role. But yeah, overall, obviously, as we can see, bearish reading. So that was nice. It was a very simple idea, really. I actually sent Nick a thesis for it. So maybe once this trade's closed, we could pull it up on stream. Trail stopped. But yeah, that's pretty much it. I mean, it's in just over 1% profit. Now, I showed you the good. Let me show you the bad. This one is Aussie New Zealand. So I didn't send this one to my Discord. I took this as a private trade on very low risk because I already was in pound Aussie. I didn't want to obviously get overexposed. So it was a residue. No, that's probably not the right word. Leftover risk that I would have applied to pound Aussie if we didn't have the Trump situation. I normally use a bit higher risk. So the risk I had left over from that, I decided, you know, I'll take a little bit of a go on Aussie New Zealand. I mean, technically, it's still okay. The only thing is that, yes, it's in a bit of a drawdown. It was an aggressive entry here, which is on the 38.2 fib level, which I don't typically use. The reason I decided to let it slide this time and do it is just because I really like this technical level. And we saw a little bit of a slowdown in price as well as this pull into the 100 moving average. So although it wasn't technically within my rule set, I was willing to give it a go. But there is still hope. The fundamentals, in my opinion, are still very, very bullish. I think it was just a case of yesterday's chaotic price action gave it a little bit of a knock. But yeah, that's all good. And then we've got the SP500. Now, this one is a bit different. This one is more of a, I guess, a position trade, if you will. So basically what I'm doing on the S&P is actually accounting for the downside, but using this downside to buy dips. So you can see here I've got a buy position with a beta of 0.25. I've got another one pending of 0.25 and another one of 0.25. Can anyone tell me, let's get a bit interactive while I have a drink. Can anyone tell me what beta 0.25 means if I'm buying the S&P? Okay, there we go. I will leave that question with you for a couple of minutes. It's not complicated. This isn't a got you question. It's quite basic, but it's not something that you hear many people talk about. But it's just a way of managing risk that's a little bit different from having just a stop loss. Anyway, so let's move on to what we could be scouting for next. What will be the next money printer for us? What's the Edge Finder saying? Thank you, Cycling. Appreciate it. Sluggy, good to see you. Sorry, I was kind of ignoring the chat then. What have I missed? Hi, James. Long on indices again? Yes, I am. Just starting to build into a position. I've got the first one in, which is the one I just showed you, but nothing large or nothing really that's worth showing off yet anyway. What about US indices? Yeah, we can go into those in a second. Try pullback on Euro Pound. Euro Pound, in my opinion, is also still long. But again, we'll move on to these in a second. Let me just answer or give you the answer to what I was just talking about before I forget, and then we move on to something else. So this is, again, is very, very simple, and this is just from the way that I go about it. I'm not sure if it can be applied in different ways, but anyway. So basically, let's just draw this first. So here and right down to 1% here. So, sorry, I'm used to my old trading platform. Let me let me just redraw that. Give me a second. So 1% would be about here. So what my beta 0.25% position is basically means, rather than going 1-to-1, so if you bought the S&P or if I bought the S&P with a slightly higher position, my beta would have been 1, or beta of 0.25. So all I'm doing is moving my P&L with the percentage price movement. So if I had a beta of 1 with the S&P, that would be 1% risk per 1% of price movement on the S&P. So rather than this being a 0.25% risk, or being down 0.25% at this point, it would have been down 1%. So you go beta 2. So you could have 2% risk per 1% move. It's just a way, really, that I'm doing to get into the S&P with very low risk and average in. So it's basically just a case of buying dips. So you can see I've got a couple of different orders down here, basically just at previous lows. And it's a case of, I don't want to be at risk. Like, I don't want to be in a large position. I don't want to have a stop loss. But I do want the exposure. So what's the way to do that? Or what's the best way for me to personally do that with my risk tolerance, my constraints, and the way that I like to trade? Well, it's like this. So worst case scenario, this position gets triggered in and we go down here. I would be roughly in about 1.75% loss, give or take. The numbers aren't exact, but the loss is not much. But the payoff for that potential loss is quite nice, in my opinion. That's what I'm willing to do. Anyway, let's move forwards. James, UK 100 is moving nicely, bought this morning. Let me see. I haven't checked the FTSE in a long time, actually. Yes, it is actually. That would be, let me re-add the hourly here. Yeah, the FTSE, interesting. I suppose, I mean, to be honest, there's not much of a reason on the H1, but I think, yeah, the H4, pretty clean. Continued uptrend, minor hit. Nice H4 bullish candle here off the 100 moving average. Yeah, nice. I mean, hopefully you should know where I stand on the UK. But the FTSE is a little bit different just because there's exporters and things in there. It's not quite the same expression that I've got with the UK sterling. So I'm not necessarily bearish on the FTSE at this point. I think I've said I was before, but I'm not right now. I think the indices markets really are a buy until further notice. It's kind of like gold and silver in terms of, you could get technical, look for short. And when I say technical, I don't mean technical analysis. I mean technical, trying to find a reason to be a short seller and justifying it. However, I think the easy side of being on the indices markets and the metals market is actually just buying dips. If you're stopped out, fine, whatever. However, I think that's sort of the, what's the saying, the path of least resistance, or just following the trend rather than trying to pick out the tops and go crazy and, America's going to war and et cetera, and, that it's just, yeah. Anyway, let's move on. Sorry, James, I had to ask ChatGPT. It's all right, Charles. I'll forgive you. At least you know now. There you go. You come to watch a stream and you get a bit of information. Can't be bad. Long time no see. Still hustling to be profitable. Here across. Yeah, welcome back. I hope this year has a positive success rate for you. 2.5 times the move. No, Sluggy, I'm going 0.25, not 2.5. So it's 0.25% risk per 1%. I would never do 2.5% per 1%. That would cripple me. Minus 2% on crowd sentiment on metals in a short. Is it? Let's see. We'll have a look here first. 95.69% long there. I'm not sure if gold's on the index here. It is. Bullish sentiment, yeah. Interesting. Yeah, I mean, the thing is with gold, there's been a couple of times where it's dropped off the edge fight. Like right now, actually, you can see gold's neutral. It's only got a score of 3. So normally speaking, I would completely avoid gold. But I think it's just been the dominating market for the past, 2-3 years at this point. It's been a long time that gold's been just parabolically bullish. Obviously, there's been short-term pullbacks and things, but overall, the only thing you had to do was buy gold. And obviously, that's easy to say in hindsight because I didn't do that. But yeah, it's one of those things. It doesn't really matter, in my opinion. As long as gold isn't reading bearish, I think it's still a buy, not financial advice. No, Sluggy, it's not like a quant thing. It's more just a different way to manage the risk and exposure. I think the only reason you would do that is if you're trying to get a long-term sort of DCA or a long-term ladder position, rather than, obviously, you wouldn't really do that if you had normal entry stop loss take profit. Anyway, so China 50, I don't really know that much about China, so we'll skip it just for now. New Zealand dollar Swiss, Aussie Swiss, let's see. What do we have in those markets? I know I was discounting Aussie Swiss and New Zealand Swiss a little while ago. I think it might have been last week. I just didn't really see much of a longer term reason. So I think, how do I explain it? The way I trade, or the way I do my analysis and find my trades, is not necessarily as simple as just looking at the edge finder. So what I normally do is go to the edge finder. That's kind of like where my trades originate from. And that way I don't spend hours researching something that's just pointless, that's got nothing going on, you know? So for example, the pound Aussie trade, I saw it here. I was like, okay, we're getting the bearish reading. What's the forecast? What's like the theme? What's going on in those economies? Not just on a indicators point of view right now, but what's sort of the policy with the central banks, etc. And I'll derive it from there. So that's why when I say I couldn't really find a reason to buy New Zealand dollar Swiss or Aussie Swiss, it's purely from my own analysis. Obviously, you can use the edge finder. I mean, in this case, if you just waited for a pullback to the 200, you'd been in the money by now. So I'm not saying that my thought process was necessarily the right one, but I'm just trying to explain why I came to that idea. Okay, so I think Aussie Swiss does have potential, but again, it's not my number one idea right now. So the reason, or the only reason personally that I would want to be a buyer, obviously we've got the edge finder reading, but we also have the RBA that is pretty much one of the, I think it might be the only hawkish central bank in the developed markets. I could be wrong, don't quote me on that. I think it's either the only one or one of the only ones. So the Aussie dollar is in my opinion, it's like the main currency to buy at the moment. So yeah, Aussie Swiss makes sense, actually. However, New Zealand dollar Swiss, which actually I don't even have on here. Let me add it. Hold on. There we go. There we go. Well, actually, there we go. Been proven wrong. Look at that. Really nice move there from the moving average cluster, or whatever you want to call it, all the way up to sort of the previous high. But yeah, it's not a nice technical market, in my opinion. I mean, since when was this? Mid-December, it's pretty much just been sideways-ish. I mean, maybe a sideways slight uptrend. But yeah, it's not been a fantastic market to try and actually get any positioning. When I say that, I use obviously moving averages to determine whether I want to be a buyer or a seller on a technical basis, of course. In this case, we have these moving averages that are just side by side. They're like train tracks, which obviously indicates there's no real trend, no real direction, which is a big problem for me. So what I would need to see from here to be a buyer, obviously a break above the previous high. I would need to see these moving averages establish a more sustainable uptrend formation, then a pullback into the moving averages, and ideally a fib as well. Then I could be a buyer. That would be kind of the only thing I could justify a position in this market at the moment, or the only way I could justify a position. I think the risk reward is good here if you go short. Short on what, Chris? James, what makes the edge finder switch so abruptly from one high bullish reading to a neutral? Well, if you look at what the edge finder uses for its scoring, so let's just have a look. Pocketing 1% on silver shorts. Fantastic, Chris. Nice one. Pound Aussie was solid. Re-entered on the same level as you, James. Good job, Sluggy. Nice one. Is your stop loss the same as his? I don't know. My country finally looking like it will shoot for 70 cents in a long time against the US dollar. Trump is still yapping. You know what? I was watching the speech just before I came on here. I've also got my news terminal open, and there's just nothing going on. So the most recent one a minute ago, actually, sorry, it was from Tesla. Yeah, there's just nothing really going on. The latest one, Supreme Court considers Trump's bid to fire Fed's Lisa Cook. But yeah, no, very sort of flat day actually from Trump. Anyway, sorry, let's go back to that question about the edge finder. So how does the edge finder flip so abruptly? Well, if we actually, sorry, let me pull up gold so then I can actually tell you, because I'm fairly sure it was gold you were asking about here. So the edge finder obviously aggregates data. So it takes into account all of this, pushes it into here and scores it from -2 or +2, obviously either way. So if there is, I don't know, let's say something that might be a +1, which is slightly bullish or slightly bearish, it's a -1, or 0, then it can really sway it the other way. So in this case, if we had, let's say COT data flipped, then it would go to a bearish reading. But it really depends on the, you know, it could be many, many different things here that have changed or developed for it to change. But that's why it changes, because it updates with obviously the data that comes out from the economic calendars. So it's all based on inflation, smart money, retail positioning, seasonality, et cetera, and labor markets as well. So it really depends on exactly what has changed, but that's hopefully kind of answered your question. It's just a change in the data that's flipped it. Although, yeah, going back to that Trump speech, I was watching it and it was just nothing. I was zoning out and doing some other work. And then I came back, like mentally came back to watching it. And the next thing I heard was just, they don't want me to wage war. We don't want to use force. And what was it? He would decimate or something. I can't remember what word he used, but it sounded quite violent. And then he proceeds saying, I'm not going to use force. I will not use force. I was like, oh, this guy is just throwing words around. James, another question on the edge finder. Are all the scores equally weighted? I think so. I would, yeah, you'd have to double check with Nick, but I would assume that it's all, yeah, pretty, is it binary, like from 0 to 2 or whatever? But yeah, I'm not sure there's dynamic weighting. So I'm not sure if, for example, seasonality gets a less weighted score compared to something like inflation. That might be a good idea, actually. Someday I'll buy for sure. Make sure you use code ELITE. It would help me out. Put some money in my pocket. So yeah, there's nothing going on my side. As I said, it's just pound Aussie. I've got a position on Oracle, which I'm not going to show just yet. It's still in the early phases. Aussie New Zealand, which is actually looking like it's pulling back, which is nice. I might add another position in pound Aussie if we can start reclaiming the 200 moving average. So this is something that I personally quite like to do, but it's definitely not. It's not sensible for many traders to copy. And the reason I like to do it is because I like to manage average prices. So it's the same with my DCA approach. So normally I'm just going to explain this and I'll call it today because I'm running out of time here. Normally I will allocate a certain amount of risk for a trade. So it really depends on how the technicals look, how do the fundamentals look, how good does this trade look on a fundamental view, and then how good does it look on a technical view. If it's all very, very clear and it seems like a great trade, I might allocate 2, maybe 3% risk on that trade. However, if it's all a little bit cloudy, I'm still pretty confident in the direction, but maybe the entry isn't the best one. Maybe I get a better entry lower or there's something else. I might just allocate 0.5 or 1%. And then in a situation like this, where it's actually respected the fib or my main fib levels, which is obviously this 61.8 and the 50%, and we're starting to reclaim this 200, I might just throw another 1% risk in just to round this off at a 2% risk position. And that would then in turn bring my average price down. It's dangerous to get into the habit of adding to losers. Obviously, it requires a little bit of understanding on the dynamics of that specific market, what's driving it, the risks, etc., etc. But that's a potential idea. If we start reclaiming this 200 and we can see buyers really stepping in and signs this trend will continue to the upside. S&P 500, excuse me, actually it's just had a really nice H4 candle close, but there's nothing really to explain here. It's just a case of I'm buying lows, buying dips, and a small size. That's it. What else is the copper? Actually, I'd quite like to run through copper, but I think it's probably going to take me 10 minutes to get through copper, so I might do this one tomorrow. Tell you what, we'll do a copper breakdown tomorrow because I think copper could be the next great buy. So if you look at, last thing I'm going to say before I end my segment here, if we look at copper, if we look at silver, how underrated was, actually, let's go to a monthly time frame. How underrated, how many times have you heard someone talk about silver up until, I don't know, let's say December, November time last year? I guarantee it was barely ever. And if you did, it wasn't anything too crazy. What's going on? Well, gold's had a super cycle, so is copper. And I don't really hear anyone talk about copper. Maybe this is the next one to potentially start looking to be a buyer of. Anyway, I'll leave it there. I do have my justifications for that idea, which I'll run through tomorrow. Guys, have a good one, and I will see you all later. Thank you for joining. Enjoy the rest of your day. Stay safe, and don't get margin called.
If you're enjoying the stream right now and would like to join us beyond just live streams, consider joining our free-to-join Telegram channel. Inside of our Telegram channel, we're sharing daily market analysis, bonus clips from the live streams and videos, giveaways to our products, prop firms, and brokerages, and much, much more. So like I said, if you're looking to stay up to date with ideas that we're looking at in markets, even if you can't make it to a live stream, consider joining our Telegram channel down below in the description of this live stream or being dropped in the live stream chat as we speak. Just click that link, it'll navigate you over to Telegram, click join, and you can come back to the stream. It's totally free to join, and if it's easier for you, you can also just use the QR code that you see on the screen right now. Now back to the live stream.
Hey everyone. Yes, speaking of the Telegram channel, I just went ahead right before I jumped on the stream here. I posted the 2 chart markups for today. Pound, or the UK, actually got some increased inflation, so I went ahead and updated you guys on that. And then the continued strength with Aussie dollar. I think James spoke a little bit on the Aussie dollar and New Zealand dollar. Man, those trades have really made me upset because I'm not participating. I've been patient, and I just can't get an entry here. I could have, should have, would have at this level here, but ultimately I was waiting for a deeper pullback. But yeah, Aussie dollar, New Zealand dollar, they're pretty strong here, and I'm sure on the Edge Finder we can just go ahead and look. So this was the UK. The pound got a surprise upbeat here in inflation. And if we go to top setups, I'm curious to see if that is reflective up there. I'm getting a white screen here. Let's see. This is going to be the let's look at the macro only. And yeah, New Zealand dollar at the top there. Major currency pairs only. So I exclude the minors here. But let's see if the okay. It seems like top setups main pages is maybe getting some work done in there. But yeah, yields on these two have been elevated here. So like New Zealand dollar, you can see staying elevated. Aussie dollar as well. This was kind of a level I had marked up here on the weekly time frame. And look at us, man. Look at the Aussie. So someone said in the chat, might see Aussie for the first time in 0.70. Yeah, I agree with you, man. And unfortunately, I'm not participating. Look at this chart. Hey, Cycling. Hey, how you guys doing? Hey, Max, how you doing? Max, I saw your message just now. I'll respond to it after the stream, but I hope all is well. Are we early adopters to the Edge Finder? I would say the Edge Finder is like a very mature, developed young man, I would say, or young woman. So it's not like super old, but it's actually it's doing well, and it does its job very, very well, and it's well respected. So definitely get you an Edge Finder, man, if you can. The play might be to get in on the 4-hour EMA for the Aussie. Chris, honestly, like, yeah, you might have to be aggressive as far as the entry approach for the Aussie. I don't prefer that, honestly. My personal thing, I would wait for a pullback just because anything can happen in this market. So Just when you think that you missed the entry and you got to buy at the top or whatever, is when something happens. And in this age, anything can happen at any time. Speaking of that, Trump right now is speaking at Davos, or he just finished speaking, and he basically said, I'll pull it up for you guys here. Excessive force for Greenland. He's not going to do that. So immediately you see dollar catch a little bit of a lift, S&P as well. And if we all remember, when Trump originally, I'll just break it down for you for those that don't know. When Trump recently said that he wanted to acquire Greenland via, putting these tariffs on, it was Denmark, Finland, Sweden, France, Germany, Netherlands. It was like 8 countries, 10%. The market did not like that, right? And the market, 10% not much, and he was going to enforce another 25% come, I think it was in the summertime. However, the EU has something in their artillery that really spooked markets, and what they have is what's called the anti-coercion instrument, or the trade bazooka. Literally, they have a bazooka, and it allows for them to kind of hold back on any blackmail from any non-European union, so they can basically pull back on trade. Services, so like any services, tech, any foreign tech that we use, that's that we use a lot. You can talk about banking services, all that good stuff. Like you have your UBSs and everything in the world, those very prestigious institutions. They can basically pull back on that, and so that kind of spooked markets as far as like sell America, and also I have this too that I was looking at. Which countries hold the most U.S. debt? Look at that. Look at in the blue chart here. You can see that most of it is, we'll exclude Canada and Mexico, but look at all this is all like EU countries right here, right? So if these guys start offloading our debt that they hold, that's not good, right? That's not good. And also, last time when Trump was very volatile and very, set stone on his thing, the bond market reacted a certain way, and markets are elevated, and that's not what he wants, right? So, Trump always tickens out. I would say that's pretty much stemmed from the bond market and the implications from that. But yeah, enough about that. Nothing really happening right now. He said he's basically not going to enforce any crazy rules or anything like that, and it seems like things are coming down. So you can see that the stock market, the Nasdaq here, is catching a little bit of a bit, perhaps recapturing yesterday's losses, but we'll see. The VIX is actually down 10% here, so it's kind of fading off back under these important moving averages. The yellow is the 200-day. And the red is the 50-day, so not quite yet at the 50-day. But it seems like things are stabilizing, and perhaps that sell America, flows that we saw in the beginning of the week is probably going to get mean reverted. And so what I did, I just posted a video on this, and I'll explain this. But as we all know, if you guys have been watching my segments of the show, I've been really involved in dollar Swiss. I was in a position, and then I got trailed out ultimately when we had this, steep sell-off. But what I did like is that this level of support, it seems to be holding for now. So from a technical basis, every time we get to this level here so far, right, things can always change, but you get a bounce up in the dollar Swiss. Think about it. 1, 2, 3, 4, 5, and potentially 6 times here in the dollar Swiss that you get a little bit of a lift off. So hypothetically, if you were to get a market order here, for example, not financial advice, of course, and put a stop right below the level of support, and you target this level of resistance, in my opinion, that's a pretty great risk to reward, right? If we actually put some math behind it, let's go ahead and do long position, market order, stop below somewhere over here. Oops, didn't mean to do that. That's a 2.45, and that's just targeting this upper end of the channel here. Let's say the fundamentals continue to go ahead and look good for the US, then perhaps we can actually break out of this ugly trend if we just go on a weekly time frame here, and we see this downward trend here, and we've been stuck in this thing for about 213 days, give or take, right? So that'd be interesting to see. You also got these moving averages here, just kind of converging closer and closer together. So if we actually get a close above these moving averages on a longer term basis, perhaps the dollar does get a little bit of a lift. Kind of ignoring the whole Trump headlines here and what really caused this recent sell-off, things have been looking good for the US, right? If you look up the Edge Finder, let's just go ahead and look at the economic heat map here for the US. Oh, this is the EU. Wrong one. Wrong one. Let's see. Let me look at the chat real quick. Did Trump threaten tariffs unless they gave him Greenland? He basically went at some major European countries enforcing tariffs if they don't, help him acquire Greenland. And he was pretty aggressive on that front. The Swiss looks good technically, but the DXY looks like it could roll over more. Maybe the Swiss support won't hold because of this. Yeah, it's a tricky situation. I won't discount that at all. But the fundamentals so far, and that's what we trade, is looking pretty good for the US. So let me explain a little bit here, and I'll also address to the other side of the coin. So I don't want to be super dollar bullishness because you also have some risk to the downside as well. But at the moment here, the yellow, anything in yellow on the edge finder is recent of the last 7 days. So if you look at retail sales here, we had a beat here. Surprise to the blue is good. PPI, which is an inflation read, came in hotter than expected, which is good for the US, bad for stocks, right? Jobless claims beat again. Now, NFP did miss expectations, but we also got unemployment rate ticked down lower. So that was actually good. And that reaction on that specific day when NFP missed, but unemployment rate came in better, was actually net positive for the US. So, and we still have other things to consider here as new data comes into the picture. But at the moment, the picture seems to be turning around for the US. And if you look here on the bottom right of the screen, you can see these 2 meters here. This is the eco surprise meter. And essentially, it just measures like how much of the recent data has actually been beating or missing expectations. Anything in the blue camp is actually good. So any recent data has been turning out better than expected. And before, the USD was at -40, and then it went to like -40 or 45, and now it's at 58. So in my opinion, things are turning around for the US. Now, I want to address the other side of the coin as well. What could happen? What can actually, throw a wrench into what we're thinking of as far as dollar bullishness? If you continue to see, for example, more tensions, right? More uncertainty, more sell America thing. Those are like very immediate reactions. But if you start to see continued cracks in their labor market, then perhaps the Fed can actually go ahead and cut interest rates in order to help the labor market here. So that's one thing that you have to consider as well. Of course, any other economic data print that goes against the US, like growth or anything like that, can go ahead and negatively affect the US dollar. But the big focus on the Fed's mind right now is going to be the labor market. They have two, the labor market and inflation. And if we just look at inflation for the US at the moment here, give me 1 second, I'll pull it up for you guys. Inflation, CPI. Inflation has been slowly ticking down here. So right now, the Fed has shifted its focus onto the labor market. And if we continue to see inflation go down in the US, then perhaps that part of the mandate is taking care of itself. And so that'll actually be good. And then the Fed can continue to cut rates. And of course, more rate cuts adds pressure on the US dollar. I don't know about you guys, but I love Trump. I mean, Trump definitely spices up the markets. You know what I mean? So from a spectator's perspective, if you're not involved or whatever, if it doesn't affect you, then it's actually interesting to see how everything, reacts and stuff. But if you're in positions and you're having to navigate through it, I could see how it can be difficult. I love how passionate about Forex you are, Alan. Max neuron activation. Man, Forex is like, in my opinion, it's I feel like it gets a bad rap in retail, but it's actually like the backbone. Like, everything, countries, everything transact through Forex every single day. Like, it's something that doesn't go away, in my opinion. In the next 100 to 200 years, I would say, traditional fiat currency, although it's, they're printing it and it's losing value and stuff like that, I think it'll always be around. Alan, but oil is going up. Isn't that bad inflation? That is actually true. I haven't looked at an oil chart here recently. I don't think anything's crazy is going on. We're somewhat elevated. So with the thing with oil, it's low relative to where it has been. Like if you're just looking left on the chart, this is all this right here is January of 25, June. So we're somewhat lower than before. But you're right. If oil does stay elevated for an extended period of time, then that is absolutely going to trickle into the economy. It's going to, cause inflationary pressures. So when you think about it, like in the US at least, most of our goods and services are delivered. Like anything you look at the grocery store, for the most part, is delivered by truck. Your like eggs have to be delivered by truck. Like you can't put them on a plane or anything like that. Like there's very specific requirements. But you think of your eggs and all this other good stuff. They are delivered by trucks, and so whenever oil goes up in the U.S., well, the shipping company or whatever, they're not gonna lose money or they're not gonna make less profit. They're gonna offset that and push that onto the consumer, and so they raise the prices of certain goods and whatever. So higher oil prices, obviously increases the operating costs for delivering goods and services, and ultimately the U.S., the citizen goes ahead and pays for that. So yes, you're right. Higher elevated oil will definitely cause that, but at the moment, in my opinion, it's not being elevated for too long to go ahead and cause a very big shift like that in inflation. But one thing though that's interesting is oil is actually a forward-looking indicator for inflation, in my opinion. So definitely a chart to always keep on the back of your mind and always monitor. ADHD kids can't handle Forex. They need to see NYNQ sessions and middle sort of moves. I like the slower pace, you could say, of Forex. It can be slow, but it can also be fast. Like it's slow for like 70% of the time, and then you can be in a position and things start to shift, and then things really, really move fast. That's what I like about it. Like because I'm in the US, I trade US macro, right? So like I put a lot of emphasis on that, but I also have to consider the other economies as well, because I'm trading in pairs. So I have to consider too. So like you could always think of it like this. Like let's say Forex is really, really slow. For example, let's just look at the dollar yen, right? That's a great example. Let's say dollar yen's flat, and then you start getting some very good things in the US, right? So dollar catches a slight bid there, but then you also have the yen also adding some pressure right there. So let's say like the dollar's doing really well, and then the yen is also doing really well. So the move's not going to be as lucrative, you could say. But if you were to find or be in early on a move when you see a currency doing extremely well while the other side of that currency pair is doing extremely bad, that's when you get like some really, really nice moves in Forex. And the only way to do that, unfortunately, is the harder path, and that is monitoring and looking at the fundamentals, especially in FX when you have data releases every single day, it seems like. Like if you just look at, for example, tomorrow's going to be a big day. Like you're trading, you have to be mindful of what's going on everywhere. You have ECB meeting minutes tomorrow, then you have US jobless claims and US GDP, and then you have more inflation data 2 hours later. You have PCE, and then you have New Zealand CPI right after that. Then you have Australian services. Then you have Japanese CPI, and then that CPI is going to be very, it's very sensitive. The yen is very sensitive at the moment, so CPI is going to move markets. And then you have the BOJ outlook, which is tentative, so they might not even, you don't know. And then the rate decision for Bank of Japan. So tomorrow's a loaded day. So it's when you're trading like NQ and ES, nothing against that, by the way, but like you're pretty much focused on US macro and basically things that can affect US macro, like outside influences. Whereas when you're trading FX, you have to be mindful of everything, and it can be slow at times. But like I said, if you catch that move or a pair that's doing really, really good versus one that's really, really bad, then it could be worthwhile. And the only way to do that, unfortunately, is by monitoring the data. And this is going to be a sales pitch, but Edgefinder makes it extremely easy. Like if you were to do this by hand, guys, like I'm being so serious right now. You put yourself at human error, you miss a release, then you don't get an accurate read or whatever. It's so time consuming because this thing, like I said, there's an economic calendar and things happen every single day. It's unrealistic for you to know exactly what's going on in every single role and then combine it in real time and get a net positive or net negative outcome. It's really hard. It's really hard. And I always say, like, if institutions don't have to do it, neither should you. So, get the tools that work for you. Like for real-time news and headlines, I use Financial Juice. It's completely free. Pair that in with the Edge Finder that consolidates the data after the fact and gives me a good reading. And then if you're like new or still trying to learn, then just join the Telegram channel. I post free stuff every day. Markups, relevant things that are moving the markets at the moment. And then if you see right here at the end of every day when the market closes, I go ahead and put a quiz, a little quiz to keep you guys sharp. So I'll go ahead and put the link to the Telegram channel, and definitely go ahead and indulge. More chances to spot opportunities. Yeah, honestly, like one thing that I didn't realize was pound Aussie was such a good trade. I only knew that because of one, you guys were all talking about it, and you guys were all referencing the edge finder, and it was getting a super bearish score. And I, go to look at it, I'm like, yeah, the fundamentals make a lot of sense, right? Pound's doing really weak. They've been struggling with growth and everything like that. Aussie dollar's looking to hike rates, all that good stuff. So fantastic trade. I missed it obviously, but I would have never have known if the edge finder didn't tell it to me. I got edge finder yesterday, and I'm up 200 USD based on edge finder setups. Not bad at all. Yeah, man. In no time, and I mean this is sincerely, this thing has paid for itself so many times over. It's not even crazy. Pound New Zealand is also crazy. Yeah, let's go ahead and look at that chart. Pound New Zealand. Look at that. And come on, I thought I had an alert on this. Obviously I had this. I usually have a level or whatever, and I put an alert. But let's see if we get a pullback into here, then perhaps I'll take it. But we're already potentially bouncing off that 200-day moving average. But yeah, I mean, if this thing continues to slide over, Pound New Zealand, you broke this bullish trend line here that's been holding since January of 2024. Now you're below these moving averages, and we get a good clean flush below, then perhaps, looking left, you have so much room to cover there. So good trade as well. Thank you, Max, for that. Silver is crashing. Let's go ahead and look at silver. 1.8%. Silver's not crashing. It's not crashing. This is not a crashing chart, in my opinion. If you look at this from a 1 minute time frame, that's a crashing chart. But if you look at it from a daily, you're still at the all-time highs, man. That's the thing with these things is like shorting, and when you think it's crashing, but then it never crashes and just continues higher. Like this was a perfect move right here. If we just look at this silver chart, the end of the year happened. Silver ended the green plus 175%, positive. Then you have this, bearish candle here, and then you short this thing. And at the time, it was a fantastic setup. And if we referenced the other times before, and it looked clean. However, look at that; it just continues chugging higher. So at the moment, silver's not crashing. You still have geopolitical uncertainties happening around the world. Things are not resolved. They're getting better, but they're not resolved. And so that's a perfect environment for metals to continue higher. You also have most of the central banks cutting interest rates, which is good for metals. And then you add in the supply factor and how it mixes in with the productions and all this good stuff, and there's limited supply of it. Silver is doing fantastic, and gold is too. So I don't think it's crashing. So definitely be mindful shorting this thing or trading it at the highs. That's one thing I'm struggling with at the moment too, is like most of these charts are ran away from me, man. Like my trading style does not allow for me to participate in any of this. Gold, silver, even the stock market, like, we're getting a broadening rotation from tech to other sectors of the market. And I would like to participate here, but we're still elevated at the highs. Things are chugging higher. Marco showed us this yesterday, but like you have this chart pattern here that looks scary. You can get a clean break to the downside, perhaps. So I'm just stuck. I'm stuck in FX, which is fine. I like FX. I'm not complaining. But when it comes to participating in these other assets, I'm gonna have to play patient, and hopefully that patient pays off. But worst case scenario, I'm gonna be in the same position like I was in the Aussie, where I'm in no trade. So that just means I'm not making money, but I'm also not losing money. So just something to just kind of have to be like. But like the VIX is slowing down, so perhaps stocks just kind of drift higher a little bit, and they kind of stay sticky at the highs here. But even then, that still means no trade. Like there's no reason to go ahead and put on some size behind anything, unless you have like a daily income strategy that can produce something, which is fantastic. I just don't have that. So that's kind of my situation at the moment. Silver scratching. Thoughts on gold is dropping right now. I mean, same thing with what I just said, man. Gold's up 1.1 on the day. This little wick means nothing in my opinion. Like it, I mean, yeah, I don't think it's crashing. Like we're still up there, man. We're only, let's see. We're 1% away from the highs. And to put in perspective, starting from the run, we're up 44%. So yeah, very, very minuscule drop, but to each their own, I guess. Let's see. And then on the topic of missing moves, I was thinking of employing a strategy where I just fade strength left and right. This way I'm always early. I mean, you technically, like with Forex, at least, like you can definitely do that. Like, I mean, an example could be dollar Swiss, right? I pulled this chart up because it's a perfect example of like how currencies mean revert for a long time. So like just looking at this right here, we're obviously stuck in this channel now. Obviously, when we break below or above these levels, then obviously the strategy is no longer in play, and then you go ahead and catch the momentum play. But when it comes to, you know, fading strength or weakness, I mean, look, the Swiss franc got super strong, you fade that, boom, okay, and then it got super weak, and then you fade that, boom, and then you got super strong again, and boom, boom, boom. You kind of just play ping pong with it. That's the thing about currencies, and so yeah, it's definitely possible. It's kind of what I'm doing with the dollar Swiss from a technical perspective. It's at this level that usually gets faded, right? But then you add in the US is actually seeing some improvements in their data and everything like that. And so it makes the trade worthwhile. It's a risk like anything else, right? Because you still have the Fed that's ultimately looking to lower interest rates. So that's one thing, is that you're somewhat fighting the Fed in that stance, but the two rate cuts are already priced in. So unless anything new happens, there's nothing out of the ordinary that will go ahead and move this thing lower. So that's kind of like my thought process and the way I justify being in this trade. Also, another thing, like I don't know if I spoke about this already on the stream, but you get income from it, right? So all of December I was in it. I made like $1,200 or something like that. Nothing like, you know, life changing or anything like that, but it offsets, you know, operating costs. But US is getting a real yield of 1.05%, right? It has the top score as far as the real yield heat map. And then the Swiss franc, if you look at it, it has a negative real yield of 10 basis points, right? So it's at the very bottom. So, you know, money over the long term flows into the higher yielding asset. When you take away all of the headlines and things like that, over time, money just drifts that way. And so, you know, US is obviously a superpower. It's the most desirable location, in my opinion, for established equities, right? An established equity market. So foreign investment always tends to come into here. And so yeah, especially when you got, you know, yields elevated, you know, at the moment, at least, money's just going to drift higher into the US over the long stretch. So that's kind of like my basis for the trade. USD is perfect for this. USD CHF taco trade. Yeah, man, that's kind of what we're doing, huh? Y'all are talking about USD CHF, but the edge finder gave New Zealand and Aussie against the Swiss a 1% gains on the day. Yeah, you're absolutely right, man. Like the edge finder will catch these gems for you. Absolutely. So make your life easy and definitely copy you an edge finder. It's worth every single penny. How is 0% inflation possible for CHF? They have a different role. You know, every economy has their own thing. Like the Swiss franc is always going to attract money during certain periods of time, right? When there is political outfall, whatever, the world's falling apart, things like that. Investors care less about collecting a yield, a high yield, and they care more about safety. And the Swiss franc is just one of those countries, right? They're very they're very neutral when it comes to certain things, so that they don't get involved. Like they're very safe, whatever. So, like this is an example of like the Swiss franc. It's a low yielding currency, but it's very, very strong. It's because they benefit off of certain environments, and we've recently been in an environment where you have safe haven appetite, right? Gold is also one of those things. We've been in an environment where safe haven appetite is up there, right? So that's why gold is really doing well, and the Swiss franc is doing really well. So with the Swiss franc is one of those things where like you also have to play the fade in headlines as well. Like in my opinion, I think the taco trade is very real. Yield scared the heck out of Trump last time, and yields are elevated now, right? The European Union has a trade bazooka that they're ready to fire off. So there's a lot of things at play that could always go ahead and fade this move on. And history has shown that Trump sometimes shakens out a little bit, right? But on that note, guys, I will leave you guys to it. Thank you guys so much for watching this segment. Again, get you guys an edge finder. Join the free Telegram as well. I'll drop the link one more time. We would love to have you. I would love to see you guys, and any suggestions, anything like that, always feel free to let me know. But have a blessed rest of your day, guys, and trade safely. Bye-bye.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.